Hello, everyone. I hope that we're doing well. We're continuing in our discussion on financial performance evaluations, particularly ratio analysis. In the past videos, we have looked at liquidity ratios as well as profitability ratios. Today, we are going to be looking at efficiency ratios, how we're efficiently using resources within the entity, within the business organization. So we're looking at inventory turnover period, trade receivable turnover period, as well as trade payables turnover period. Okay, so let's get started. So we're looking at how we efficiently using resources. With the inventory turnover, we want to know the number of times that the stock within the company is being sold, the inventory is being sold within an accounting period. So it's looking at is the business maintaining an appropriate level of inventory, or are you just overstocking, you're piling up stock? So it's very important for us to look at this, because if as a business you're just piling up stock, you're going to be incurring more cost in maybe warehousing cost, storage cost, and all of those. So it will be good to keep the stock level that is required, and ensuring that the stock that we have, we're quickly, turning that over so that we don't have to incur unnecessary costs. So a reduction in our inventory turnover would usually mean that the business isn't selling the stock as quickly as it should. Instead, it is piling it up in, in stock, incurring other costs. It could also mean that, if you're not selling your inventory the way you should be selling the inventory, you could run into liquidity crisis, in the sense that when you then need money, the money you're supposed to use to settle debts or make investments and all of those is tied up in inventory that is not necessarily giving you any returns. So that's why it's very important for us to do this calculation. So with inventory turnover, the formula for calculating your inventory turnover is your cost of sales. So your cost of sales, is going to be your cost of sales So that will be your cost of sales divided by your average inventory. And when we say average inventory, you get your average inventory by adding your opening inventory and your closing inventory, and you divide that by 2, you will get your average inventory. In some questions, you may not be given your opening inventory. So when you're not given an opening inventory, but you have a closing inventory, you use your closing inventory figure. But usually your inventory turnover is your cost of sales divided by your average inventory yield. So how quickly is this business turning over its inventory in the year? Let's look at an example. So here we've been told to calculate the rate of inventory turnover for the year 2009 and 2010, and this helps us to do a comparison of what we have. So here we've been told that don't forget what the formula is, our cost of sales. So we need to have our cost of sales, and we divide that by our average inventory. So this would be needing our closing inventory as well as our opening inventory, because our average inventory is we add opening inventory plus closing inventory and we divide that by 2. Okay, so let's get started. Our cost of sales here is 5,600. So you need to be able to identify your cost of sales, which is cost of goods sold, cost of sales. So you have your sales minus when you have your sales figure, you less your cost of goods sold, we have our cost of sales. That's 5,600. And in 2010, we have 7,000. So we've been able to identify our cost of sales. The other thing to identify is our average inventory. In 2019, opening stock is 500. So we need to take note of that one. So we have here 500 and our closing inventory is 900. In 2010, opening inventory 900 and our closing inventory is 1,100. So those are the key figures that we need. So in 2019, our inventory turnover is cost of sales, which is 5,600. We divide that by average inventory. How did we get our average inventory again? We add 500 plus 900, and that gives us 1,400. We divide that by 2 and we have 700. So 5,600 divided by 700, we have 8 times per year. So the inventory is being turned over 8 times per year in 2009. 9. In 2010, we do the same calculation. Your cost of sales, we have identified 7,000 here, divided by your average inventory, 900 plus 1,100 gives you 2,000. 2,000 divided by 2, we have 1,000. So 7,000 divided by 1,000 gives us 7 times per year. 7 times per year. So you're seeing that in 2010 compared to 2009, it's it's slowing. We're not. It's slowing. There's a slowdown in how many times the inventory is being turned over. It means that we're having a lot of pile up, of stock, and that shouldn't be so. We want our stock to actually go very quickly so that we have more money, which we can then use for various investments and all of that. We don't incur cost in warehousing or storage and all of those. Okay, so I hope this is clear, and we should be able to solve any questions on inventory turnover. The next one we're looking at is our inventory turnover period. And in the inventory turnover period, we're looking at, how long is it taking to sell our inventory? How many days is it taking us to sell our inventory? So with the inventory turnover period, all we need is also just like our average our inventory turnover, you need our average inventory be divided by our cost of sales, and we'll multiply it by 365 days. It's important to know how many days it is getting us to sell our inventory so that we'll be able to negotiate with our suppliers, the trade payable period. We'll be able to negotiate with them how many days it should be that they should give us, they should extend trade credit to us. It also give us, also enable us to be able to also offer some credit terms also to our customers. So we know how many days it is also that, we give them, we'll sell items to them too on credit. So here it is average inventory divided by our cost of sales, you multiply it by 3,600. And we've used, our previous information here where we have our average. Our cost of average inventory is already 700. So it means we have 700 divided. So here we have 700 divided by 5,600. So we come here and say we have 700. We divide that by 5,600 and we multiply it by 365 days. And in that case, here we have 365 days. We have 46 days. So we have 46 days. So here our inventory turnover for 2009 is 46 days. So it takes us, about a month and some days to be able to turn over our inventory. Whereas, if we look at for 2010, here we have 1,000 and 7,000. So if you go 1,000 divided by 7,000, I'll multiply by 365 days, and that should give us, so if you do 1,000 divided by 7,000, multiply by 365 days, that gives us 52 days. 52 days. So we have here 52 days. In 2010, it takes 52 days to be able to sell, to turn around our inventory. So it's taking a longer number of days to do that. So this information then helps us to know, what type of negotiations we should have with our suppliers. How many days should they extend to us until when we repay them for what they have supplied us. Okay, so I hope this is clear. We should be able to answer, questions with regards to inventory turnover period. Okay, so let's go to trade payables turnover period. Like I mentioned before now, those information helps us to be able to do some form of negotiation, with our suppliers. So what the trade payable turnover period tells us is how long our business is taking to pay back trade payables, and it is important for us to know this, apart from helping us to negotiate, but we want to have a good relationship with our key stakeholder, our supplier. We want to ensure that, we're paying them on time and all of, and all of those. So if we want to have those type of good relationship, it's important for us to be aware of how long it's taking us to pay our suppliers and what we need to work on with that. To calculate our trade payables turnover period, we need our trade payables. So how much trade payables? We divide that by our credit purchases. Our credit purchases, and you multiply it by 365 days. 355 days. At times, you might not be giving your credit purchases. Where you're not giving your credit purchases, you're going to assume that all of the purchases were done on credit, and so you use all of the purchase figure. If you're not giving purchases at all, we're going to use our cost of sales figure. Use our cost of sales. So it's trade payables. We divide by our credit purchases, multiply that by 360 days, and it will tell us how many days we're taking to pay back our trade payables. We're taking back to pay our suppliers for what we bought on credit. Okay, and then the other one we're looking at is our trade receivable collection period. So the previous one, we looked at our own relationship with our supplier, how long it is taking us to pay back our suppliers. With the trade receivable collection period, we're looking at how long it is taking our customers to pay us. Are we what is the trade term we're extending to our customers? Are we allowing our customers to hold on our money for a long period of time? Money that if we had collected, we could have, invested it in something, one thing or the other, but we have left it tied up with our customers. So we want to know, how many days is our money being held up by our customers? To do that, we're going to have our trade receivables. We divide that by our credit sales, and we multiply by 365 days. Where our sales figure, our credit sales figure is not given, you assume that all the sales is done on credit. So we pick our trade receivables, we divide that by our credit sales, and we multiply it by 365 days. And it tells us how many days it is taking our customers to pay us back money that is being owed to us. Okay, so far we've looked at efficiency ratios, how our resources within the organization is being managed, is being efficiently used. We've looked at the turnover inventory. We've looked at the period. We've looked at the trade payables payment period, and we've looked at the trade receivable collection period. We'll end with this for now. I'll see you in subsequent videos.